Section 3:1 Introduction to Modern Portfolio Theory, Portfolio Diversification. 3.1 Benefits of Diversification. Diversification is a key strategy in portfolio management that aims to reduce risk by spreading investments across different assets, asset classes, sectors, or geographic regions. By diversifying, investors can potentially lower the overall risk of their portfolios while maintaining or improving the potential for returns. Here are some advantages of diversification in reducing portfolio risk. Risk reduction through correlation. Diversification helps reduce portfolio risk by incorporating assets that have low or negative correlations with each other. Correlation measures the relationship between the price movements of different assets. When assets have low or negative correlations, they tend to move independently of each other. As a result, when one investment performs poorly, another investment with a different correlation pattern may perform well, thereby offsetting losses and reducing overall portfolio volatility. Reduction of unsystematic risk. Unsystematic risk, also known as specific risk or company-specific risk, is the risk that is specific to an individual investment or a particular sector. It can arise from factors such as management decisions, industry-specific events, or financial performance of a single company. Diversification allows investors to mitigate unsystematic risk by spreading their investments across multiple assets. By holding a diversified portfolio, investors can reduce the impact of negative events on any single investment, as losses in one area may be offset by gains in others. Protection against sector or industry-specific risks. Diversification across different sectors or industries helps protect against risks that are specific to a particular sector. Economic conditions or events may impact certain sectors more than others. By holding investments across various sectors, investors can reduce the impact of adverse events or downturns in any specific sector, thereby limiting the overall risk exposure. Exposure to different asset classes. Diversification allows investors to allocate their portfolio across different asset classes, such as stocks, bonds, cash, commodities, or real estate. Asset classes have different risk-return characteristics, and their performance can vary under different market conditions. By diversifying across asset classes, investors can spread their risk across different market segments and potentially benefit from the performance of assets that behave differently in different market environments. Smoother portfolio performance. Diversification can lead to a more stable and smoother portfolio performance over time. By reducing the impact of extreme price movements in individual investments, a diversified portfolio can experience fewer severe fluctuations and provide a more consistent return stream. This can help investors maintain confidence and stay invested during market volatility, ultimately contributing to long-term investment success. Improved risk-adjusted returns. Diversification allows investors to optimize their risk-return trade-off. By combining assets with different risk and return characteristics, a well-diversified portfolio can potentially improve risk-adjusted returns. It aims to provide the highest expected return for a given level of risk or the lowest level of risk for a desired expected return, as demonstrated by the efficient frontier in modern portfolio theory. While diversification offers advantages in reducing portfolio risk, it is important to note that it does not eliminate all risks. Systematic risk, also known as market risk, cannot be diversified away as it affects the entire market or a specific asset class. Nonetheless, by diversifying intelligently, investors can manage their risk exposure and potentially achieve a more balanced and resilient portfolio. Correlation is a statistical measure that quantifies the relationship between the price movements or returns of two or more assets. It is a crucial concept in portfolio diversification as it helps investors assess the degree of dependence or independence between different investments. Understanding correlation is essential for constructing diversified portfolios. Here's an overview of the concept of correlation and its impact on portfolio diversification. Positive correlation. When two assets have a positive correlation, their price movements tend to move in the same direction. In other words, when one asset's price increases, the other asset's price also tends to increase, and vice versa. Positive correlation implies that the two assets move together, and they may have a high degree of similarity in their performance. For example, two stocks from the same industry sector may have a positive correlation. Negative correlation occurs when two assets move in opposite directions. If one asset's price tends to rise when the other asset's price falls, they are negatively correlated. Negative correlation indicates that the assets have a tendency to move in opposite directions, providing potential diversification benefits. For example, stocks and bonds often exhibit negative correlation, as investors may shift their investments from stocks to bonds during periods of market downturns. Zero correlation indicates no relationship between the price movements of two assets. The performance of one asset has no predictable impact on the performance of the other asset. Zero correlation means that the assets are independent of each other. However, it is important to note that zero correlation does not imply that the assets are risk-free or unrelated to other factors. They may still have their own individual risks. The impact of correlation on portfolio diversification can be summarized as follows. A. Diversification benefits. The primary goal of diversification is to combine assets with low or negative correlations in a portfolio. When assets are negatively correlated or have low correlations, they tend to move independently of each other. By holding a diversified portfolio with assets that have low correlations, investors can potentially reduce the overall risk of the portfolio. During periods of market volatility or economic downturns, the losses in one investment may be offset by gains in another, leading to a more stable portfolio performance. B. Risk reduction. Correlation plays a crucial role in risk reduction. When assets in a portfolio have low or negative correlations, their price movements tend to offset each other to some extent. As a result, the portfolio's overall volatility or risk is reduced. By diversifying across assets with different correlations, investors can potentially reduce the impact of negative events or downturns on the portfolio. C. Portfolio optimization. Correlation analysis is used in portfolio optimization techniques, such as modern portfolio theory, MPT, which aims to construct portfolios along the efficient frontier. MPT suggests that assets with low correlations provide better diversification benefits and contribute to more efficient portfolios. By combining assets with different correlations, investors can potentially maximize their expected return for a given level of risk or minimize their risk for a desired level of return. It's important to note that correlation is not a static measure and can change over time. Market conditions, economic factors, or other events can influence the correlations between assets. Therefore, ongoing monitoring and adjustment of the portfolio are necessary to ensure the desired diversification benefits are maintained. In summary, understanding correlation and its impact on portfolio diversification allows investors to construct well-diversified portfolios that can potentially reduce risk and enhance risk-adjusted returns. By selecting assets with low or negative correlations, investors can build portfolios that are more resilient to market fluctuations and provide a smoother investment experience.